Okay, good morning, everyone, and welcome back to week 6 of Business 1750 Personal Finance. If you hear some random beeping, this morning they are working on some control panel out in the hallway outside my office this morning, so if you hear random beeping, it's because of that. This week, please don't forget, test number 3 is open and available to you this week and this week only. We're going to be covering this week chapters 12 and 13, which chapter 12 is mutual funds and chapter 13 is stocks. So we're continuing our exploration of investments from last week, where we started with investment basics with chapter 11. And we have some learning outcomes that we'll address for the different chapters. 5 of them for chapter 12 and 4 of them for chapter 13. But the roadmap for this week, as always, go all the way back to chapter 1 and look over your PowerPoints so that you don't forget what we did back at the beginning of the class. This week, we're going to concentrate on reading chapters 12 and 13 in the textbook. In addition to looking over the PowerPoints, please don't forget to read the chapters. And also use your books to help you with the problem assignments, the chapter quizzes, and the continuing case studies for both chapters 12 and 13. So we have some work for each one of those chapters, just like always. It's nothing really different than it normally is. So as usual, sorry, I noticed that there was something boldface on the roadmap, and I wanted to take it off there. So, and then as always, after you've done all of your as you do all your work, make sure that you, by Wednesday, post your initial post to the discussion board, and by Sunday, post at least 2 responses to your classmates. So just to recap, this week, review chapters 1 through 13 PowerPoints, read chapters 12 and 13 in the textbook, complete the chapters 12 and 13 problems, the quizzes, and the continuing case studies, and you have 1 group discussion for the week. Initial post due by Wednesday, 2 replies due by Sunday. Okay, so we are moving along quickly. So let's take a look at chapter 12, mutual funds. Mutual funds is a type of investment that a lot of people use. I use it as part of my retirement plan here at Methodist University. It's one of the options that we have. There are 5 learning objectives that we're going to address during this chapter. We're going to appreciate the history of mutual funds and understand mutual fund basics. We're going to examine the types of mutual funds. Number 3 says assess the benefits and risk of mutual funds. Number 4 is evaluate mutual funds in terms of their class, commission, and fee structure. And number 5 is plan how and where to invest in mutual funds. Okay, so mutual funds is a way where you can do some investing that is a vehicle, an investment vehicle is what the book uses, of pooled funds that buy assets with a specific investment objective operated by a fund manager. What does that mean for you as the investor? As the investor, what you do is you sign up, you do some research on what types of mutual funds you want to invest in, and different types of mutual funds. Some invest in more aggressive stocks and bonds and stuff, and some invest in less aggressive, and you can mix it and match it however you want. But basically, you sign up and tell them how you want your money spent, and then a fund manager is a person or a group of people responsible for an investment fund. They're a stockbroker or other financial professional, and they manage the mutual fund for you. Because very few of us have the time or the energy to watch the stock market closely. And unless you're a trader by profession, you're not going to watch the stock market close enough to stay on top of everything. You pay somebody to do that for you. And a mutual fund is one way where you can diversify your portfolio and not have all your stocks the same. That way, if one doesn't do so well, you don't lose all your money. Which you remember we talked about that a little bit last week in investment basics. But it's a way to diversify your investment without having to become a trader where you sit there and watch every move and do every transaction yourself. A closed-end mutual fund is defined as Oh, excuse me. Oh, so sorry. A publicly traded mutual fund that raises capital through an initial public offering or an IPO with a limited number of shares. No new investment funds can be added after the IPO. So with a closed-end mutual fund, if you don't get in on the ground floor with it, in other words, if you're not like invited in and it is publicly traded, but if you don't buy in during that initial public offering, you don't get to join in later. Okay, it's like for the people who it's designed for the people who jump on it at the beginning, and then there's no new investors after the initial public offering. An open-end mutual fund is the exact opposite. It's a mutual fund in which investors can buy shares at the net asset value of the fund, and new money can be added anytime. You can just jump in, jump out as you see fit. So it's not a closed off where if you don't get in at the beginning, you don't get in at all. Some advantages, I would say, is the instant diversification with a small amount of money. You don't have to invest thousands into a mutual fund to see a return that's substantial and it's diversified. You can invest with small dollar amounts, and it's spread out over all of the different stocks that are included in the fund. And generally, there are lower transaction fees on mutual funds. And we'll talk about the different types of how you pay the fees. And there is a professional fund manager, someone who is there. It's their job to look after it. You don't have to look after it. So, for most of us, like I said, we don't have time to pay it as close enough attention as necessary to manage a stock portfolio, unless that's what you're doing as your job. If you want to be a trader on the stock market, that's beautiful and that's wonderful. But if you have a different job, you don't have time to do your real job that you're going to be doing, plus have the time and energy to devote necessary to keeping up with all of your investments. A history of mutual funds. In 1893, the first mutual fund in the United States was a closed-end IPO offered through the Boston Property and Trust. And then, of course, in 1929, the stock market crash took it, along with most closed-end mutual funds, and they just died, right? Jumping way forward into the 1980s, open-end mutual funds gained popularity, with individuals being able to invest their 401k retirement plans in mutual funds, and that's how I do it, through my 401k plan. And then in 2013, median investment in mutual funds by household equals $100,000, so that's the average. Also in 2013, 92% of mutual fund owning households are saving for retirement, which makes sense. And mutual funds are regulated by the Securities and Exchange Commission, also known as the SEC. So let's just take let's just take a quick look. Let's look up some information about mutual funds in 2025. Well, Charles Schwab, E-Trade, PGIM, you can just Google, they're popping up best 10 mutual funds for 2025. Forbes has a list. Let's see, there's one for May of 2025. Forbes says 5 attractive mutual funds to buy in 2025. And Forbes is telling us that they like Fidelity Contrafund, American Fund, that they have. Fidelity Contrafund is the name of the mutual fund, and it is 155.1 billion. Top holdings, they invest in Microsoft, Apple, and Amazon, so those are pretty good companies. American Funds Growth Fund of America, that's kind of redundant, but anyway, 288.9 billion. They invest in Tesla, Nvidia, and the Meta, so Facebook, those kind of things, Facebook and Instagram. T. Rowe Price Small Cap Value at 11.3 billion. Pinnacle Financial Partners, Columbia Banking System, and Technip FMC are their major top holdings. PIMCO Income Fund with 172.3 billion. They're more conservative. They do government and corporate bonds, which is a safer investment. It will grow slower, but it will grow. And Vanguard Wellington with 113.1 billion. They are back with Microsoft, Apple, and they do Nvidia. So, you know, they are, it goes through and talks about each one of those funds. If you want to look that up, the name of the article is 5 Attractive Mutual Funds to Buy in 2025 from Forbes magazine. So I would suggest that you look it up. But mutual funds are well regulated through the SEC, and a lot of people trust them for retirement funds because you can get in without having to put millions of dollars in of your own. You get in with relatively small investment every month, a percentage of your paycheck or whatever every pay period, and you let them grow it for you. So some costs and fees of mutual funds. A front end load is you pay all the fees up front when you buy the stock. It's a purchase fee to pay commissions. So when you front end load something, you pay the fees, you buy the stocks, and then when you sell the stocks, you don't have to pay any fees, you just get your money back. A back end load is the opposite. You pay the fees and all of the stuff that for commissions for the stockbrokers and everything, you pay that out of your payoff when you sell the stock. So it's the other end. A no load mutual fund has neither front nor back load, and what happens with those is they rose in popularity in the 70s. What they do is you pay the expenses ongoing, so it's not a lump at either end. Net asset value, or NAV, is the abbreviation for it. It's the total value of all the assets in the mutual fund minus the cost divided by the number of shares outstanding, which is the share price. So it's how much is each share worth if you take the cost away. So it's really a true value of each share. It's not a gross value. The expense ratio is the total operating expenses divided by the average dollar value of the fund's assets under management, usually between 0.2% and 2.5%. So it's a low per share cost because it's divided up among so many people. And the 12B-1 fee for marketing to potential investors must be disclosed in a prospectus. In other words, this is how much they're going to charge you for marketing to other investors, and they must tell you that in the prospectus. So if you have a front and back end load, if you invest $100,000 in a 5% front end load fund, 5% or $5 is used to pay sales commissions to financial intermediaries such as financial planners, brokers, or investment advisors, and that's done either at the beginning or at the end. When front end, it's done when you pay the $5 or whatever the fee is when you purchase. Back end is when you pay it when you cash out. However, understand that back end loads are paid when selling shares of a mutual fund within a specified number of years. This is usually 5 to 10 years and usually decreases annually until the holding period ends. So if you had a 5% back end load within the first 5 years of holding your mutual fund and you sold $1,000 of your mutual fund, you would have a $50 back end load. That makes sense. It adds up. And so you just have to be careful about all the fees, and the prospectus outlays the fees. And so there's some characteristics of mutual fund investors on the PowerPoint. How many people own mutual funds, and who are these people, and what do they own, and when and how they make their first mutual fund purchase and why they invest. Of course, these dates are older because the textbook is getting older now, but 94% of the respondents surveyed said the reason they invest for retirement is for retirement, and that makes sense, and I think that would probably hold fairly true for today. Retirement investments such as 401k plans, Roth IRAs, and traditional IRAs and other retirement plans allow the investor to choose from a selection of mutual funds. And if you recall, when we talked about setting up IRAs, individual retirement accounts, which are done not through a work but through the individual personally, you can set up an IRA and have it managed through a mutual fund and have your stock portfolio managed through a mutual fund. And remembering the difference is whether the money is pre-tax or taxed. A traditional IRA, your money is put in pre-taxed, and when you take it out, you pay taxes on it. A Roth IRA, the money is taxed as you put it in, so when you get it out, you don't have to pay taxes on it. So just remember the difference between the two. An actively managed mutual fund has a professional fund manager that works trying to maximize your return and actively seeking out assets that meets the objective of the funds. Higher trade volume and higher expenses because it costs money to pay people to do that. Index funds follow well-known assets. They're really not as actively managed. They just kind of go with the flow. It is a lower trade volume and lower expense because the cost of trades equals lower expense ratio. There's not somebody in there every day. They just kind of follow the stock market. So index fund, if the stock market, if a particular stock does well on a given day, like today, tomorrow an index fund might invest in that stock because it did well today. It's using hindsight rather than intuition and actively having a person manage the fund. That's why it's less expensive. Exchange traded funds, or EFTs. Usually these are index funds. They've grown in popularity because exchange traded funds do not settle at the close of business, but they trade throughout the day. So if you, in other words, if you decide to sell a mutual fund and you put in a sell order at 9 a.m., your order will be actually be fulfilled after the day closes and the new asset value is determined if it's a regular mutual fund. But if it's if your mutual fund increases that day, you benefit. However, if the mutual fund decreases, you do not benefit. So you get. So in other words, if I tell my broker at 9 a.m., hey, I want to sell out, that's technically not going to take effect in a normal mutual fund until the end of the day. And so during the day, if the fund makes money, I will make money. If the fund loses money, I lose money. However, with an EFT, if I call at 9 a.m. and say, hey, sell my stuff, they're going to sell it at 9 a.m. So I don't get the benefit of any rising prices during the day, but I also don't take the loss of any dropping prices. So you have a little bit more, that's why they're popular, because you have a little bit more direct control over when your money is when your stock is being sold. I'll get it out in a minute. I'm sorry. So equity mutual funds are stock mutual funds classified by the Morningstar Style Box. And we're going to talk about more of that in chapter 13. But it's very specific sectors of the economy, such as energy, healthcare, or technology. And they also focus on the size of the company. That you either do like large companies or small companies, whatever. They're classified by their capitalized size, or cap, generally into small, which is less than 1 billion, medium, which is 1 to 5 billion, and large, which is over 5 billion caps. So when you see a cap listed, small cap, medium cap, large cap, you know how much money the company's worth. Bond mutual funds contain only bonds and are classified by the types of bonds that are being purchased. For example, you can do municipal bond funds, and usually municipal bonds are things like states or local cities or towns will do a municipal bond to build a new courthouse or to improve roads or something like that. And what you're doing is you're investing with your money into the bond to give the state or the town the money to buy or build whatever they're going to build, and then they pay you back. Treasury bond funds help fund the treasury, the money engine of the country. And corporate bonds, of course, are investments in different corporations, much like stocks. Bonds, we're going to talk about bonds in chapter 14. They have their own chapter. Bonds are rated according to safety. And so you can choose whether you aggressively or less aggressively invest in the bond market, depending upon what you want to do. Government bonds are very low risk, but you're not going to get a lot of return on it because it's low risk. Junk bonds may be very risky because they're in startup companies or companies that don't have really good ratings, but hey, if they take off, you're going to make big money. It's just, do you wish to gamble with your money or not? That's all this is a big old gamble. The stock market and the bond market. Money market mutual funds, or MMMFs, are the least risky, but they're not insured. Okay, you don't have like at your bank account where you have the FDIC or the NCUA to stand behind you. They consist of short-term investments and maintain a net asset value of $1 per share. So you're going to at least make $1 per share. Hopefully, that's the least you can make. But they're not insured, so you're not going to. If you lose everything, you lose everything. There's no insurance on it. Balanced mutual funds contain both equities, which is stocks, because you own stocks, and bonds, which is you're loaning money. That's the difference between the two. Stock, you're buying part of the company. Bonds, you're loaning money to somebody for a reason, like I said, like building roads or whatever. And sometimes even cash. The advantage of a balanced fund is you can select one to meet your specific asset allocation needs, and you do not have to rebalance your investments personally. The fund manager will rebalance the mutual fund to meet its specific asset allocation. So you would tell your manager, your fund manager, hey, I want 50% of my money to be in stocks, 25% to be in bonds, and the other 25 in cash investments. Okay, or whatever. And they do have a targeted date fund so that you can get your, especially with the bonds, you can withdraw your money on a schedule. Global and international funds invest in companies from foreign countries. Global is domestic and foreign. So global, if it's a global fund, it's both American and other countries' companies that it looks at. An international fund is outside the U.S. only. Bond mutual funds contain only bonds and are classified by the types of bonds in the mutual funds. And I think we talked about that. And sector funds, identifiable sectors within the economy. So if you say, I want to invest only in technology, you choose a sector fund that targets technology, healthcare, utilities, the arts, whatever you want to do. There's a chart from 96 to 2013 about different types of assets and closed-end funds, EFTs, UITs, total mutual funds, etc. So it's a chart of how many people are investing. But this one to me is more important, is the benefits of mutual funds. So the next slide in the PowerPoint is also in your book as well. It's figure 12.3 in your textbook. It's the specific benefits of mutual funds. First of all, they're professionally managed. You don't have to do it. You have a professional stock broker to represent your interest, and they work for you because you're paying their fees. It's diversified. It's a variety of funds where you have the ability. At the time of printing, there were 8,000 plus funds, varying degrees of risk, investment objectives, and you can tailor your investment to where you feel comfortable. It's fairly easy to understand because the prospectuses that are given to you are written in common English. The fees, the holdings, the risk, and the investments must be explained in the prospectus. It's easy to research through online websites. You can look up all that information to look at past performance, expense ratio, reviews of what other investors have to say about it, what other investing experts have to say about it, everything. It's a low initial investment. Many allow investors to open up an account for as little as $50, and then you can just keep adding to it. So you don't have to have a lot of money to start with, which is good. That means you can start early and just keep adding to it. It can be considered an automatic investment because you can set it like mine. There's an amount taken out of my paycheck every time I get paid. I don't even have to think about it. It's easy to keep the records. You basically, they do the record keeping and they send you tax information for the previous year. And the liquidity. Remember we talked about liquidity, how quickly can something be turned into cash? Many mutual funds allow transfer of funds, money, from the sale of mutual fund shares directly into the checking or savings account either 1 or 2 days after the sale. So relatively quickly you get your money, 1 to 2 days, which is nice. So they have a slide there that talks about dollar cost averaging versus continuous automatic investing. Dollar cost averaging, you invest a specific dollar amount, you choose how much, and you divide it into equal amounts over a specific time period, such as 10 months or what have you. Both of these strategies, whether you continuously automatic invest, which is what I do, you take the timing, the market out of play, because there's the whole thing about stock investing is buy low, sell high. Well, we're in it for the haul, especially if you're going towards retirement. So you don't worry about trying to sell and buy so often, because that you'll run yourself into the ground. So with the dollar cost averaging, you set up a time period, and the example in the book says 10 months, and you invest a certain amount of money. You tell it how much. I want. The example says I want to invest $10,000, and I want to do $1,000 over 10 months. Okay, and that's one way to do it. And there's a definite start and end date. The continuous automatic investing is what I do. I just, every time I get a paycheck, it goes in. So there's no end specified amount or end date, because it's usually a percentage of my paycheck. And if I'm doing, like right now in summer school, this is considered technically an overload. So I'm getting paid extra money to do a summer course. And so it's technically extra money going into my mutual fund because I'm working extra. So, a lot of people use the continuous automatic investing for retirement because, again, we're not on a time schedule. We're working towards the long haul. Some risk of mutual funds, because there's always risk. There's, it's never everything's always roses. But only as secure as the assets they hold. So if you're a fund manager, you need to look for an experienced fund manager and check out what has been their historical return, because a mutual fund can lose money if it's poorly managed, just like anything. So you want to make sure, watch the turnover rate. The turnover rate is the percentage of stocks turning over every year. If the rate is high, investors will have more short-term capital gains and losses, which are currently taxed as normal income, whereas long-term capital gains, usually has a tax cap of 15%. So if it's a lot of coming and going, you may end up having to pay more taxes on it. And that can, of course, bite into your profits. So there is it says see page 314 of the textbook, but there's an example of looking at mutual fund prices. This is the Vanguard 500 Index Fund shares, an example there. And the cost and classes of mutual funds. We talked about front-end load, back-end load, commissions, because sometimes they do commissions per trade or whatever. You get so many trades for free, and a fee-based planner. That is someone who works with you. And then we have the share classes. We have Class A, Class B, and Class C. Class A is usually front load, and it is 2B-1 fee of about 0.25%. Remember, we said that was your marketing fee at the time of the purchase. And the benefits is basically fund sponsors typically waive the sales load for purchases made through employer-sponsored retirement plans. So if you get that Class A stock, it's usually more expensive stock, but you get some advantages to it. Class B is backload stock, 12B-1 fee, and CDSL typically decreases each year for 6 to 7 years until it reaches 0. So it starts high, and then the longer you hold it, it goes down. Remember, that backload fee changes with the years. The advantage of that, of course, there's no front-end fees. You don't pay any fees until you sell out. Deferred sales charges. You can convert it to Class A shares, and it's best for people with little cash and long time horizons. If you're planning on holding on to it, go ahead and do the backload. And Class C is level load, annual 12B-1 fee, typically 1%, and a CDSL, also often 1%, that shareholders pay if they sell their shares within the first year after purchase. There's usually no front-end fees. There's a small back-end load, and you do have the opportunity to avoid the back-end load. So it just depends on how you want to invest your money. There's advantages and disadvantages to all three types. The best thing with a mutual fund is know what is your investment objective, and know your acceptable risk level. Research the funds to find one that works best for you and your comfort level. Read the prospectus for the different funds, because you can read them without purchase, and that will give you information such as the fund investment objective and strategy for achievement, principal risk of investing, the fees and expenses, what their past performance is, and what their current holdings are. And then you can take a look at it and make a decision whether this will work for you or not. We talk about the Morningstar box. Again, we mentioned there's a picture of it in the book in Figure 12.7. The box shows if the mutual fund holds stocks of large, medium, or small cap companies on the vertical axis, and the horizontal, so up and down is small, medium, or large cap. There's 3 rows, that makes sense. And the horizontal axis is based on company valuation, whether the stocks are from value-based companies, growth companies, or a blend of value and growth, which is in the middle. So there's 3 columns. It's a 9x9 box, and basically, if you're in the bottom left corner, your mutual funds hold stocks primarily of smaller cap companies, and they're classified as value based on a price earnings ratio. So, but if you're, and that's colored in red on the little example, and if you're up in the upper right box, mutual funds hold stocks primarily of large cap companies. Stocks are classified as growth based on a price earnings ratio. So the further lower and further to the left you are, the smaller the companies, and the more conservative the investment. The more to the right you are, and the higher up you are, the larger the companies, and maybe the more aggressive the investment. So if you feel uncomfortable managing your own investments, you would want to talk to a financial planner, a financial advisor, a stockbroker, or a local banker and find out how do they get paid. Now, I'm just going to tell you, I've mentioned a couple times before, it's a lot to try to manage these stocks if you're going to do it on your own. So for the amount of money that you're paying for a mutual fund, you might as well go ahead and get it, unless you're going to be a trader yourself. Go ahead and get go ahead and invest in a mutual fund because it's just easier. How do you do it? You open an account online with a mutual fund company once you have decided which one you like and you've looked at the Morningstar box and found your comfort level. Mutual fund company such as Vanguard, Fidelity, Oppenheimer. Look at the requirements to open an account. How old, do you have to be a certain age? Can you do it at age 18, age 21? And is there a minimum balance? A discount broker might be something like Scottrade, TD Ameritrade, or E-Trade, because you're doing a little bit more of it yourself then. Do you want to just go with a financial planner that assists you and you kind of drive the show, or do you want to go through your bank? It depends on what level you're comfortable with taking on the ability to manage your own fund. Then they give you some target fund samples to look at and some links, popular online references, very, very well known, the Morningstar people, the authors of the Morningstar box, Yahoo Finance, Google Finance, Value Line, Wall Street Journal, MSN Money, and CNN Money. And that's chapter 12. There's a little summary there and some suggestions of what to do. Think it through, get to work, some little exercises. Please take advantage of those. That's chapter 12 about bonds. Chapter 13 is about stocks, which, much like bonds, I told you, if any money that you put into the stock market or in the bond market, please put money in there that you can consider to be spent, because if you lose it, it's gone. Okay, so chapter 13 talks about stocks. There are 4 learning objectives. Understand the basic principles of investing in stocks in the stock market. Explain how stocks are valued. Describe how companies on the stock market are valued, and summarize the basics of buying and selling stocks. Stocks, unlike bonds, stocks represent ownership. When you buy stock in a company, you become a part owner in it. Usually your privately held companies have a relatively small number of stockholders, and the stock is not traded on a public scale on a stock exchange. Let's see, some examples of some privately held companies. In 2025, because they have some examples. Some examples of privately held companies. I'm looking. There's a company called Farcaster. They're a decentralized social network protocol that aims to provide users with more control over their social interactions and data via blockchain. The company's core application is called Warpcaster, which has been likened to a blockchain-enabled version of X or Twitter. Farcaster was founded by 2 Coinbase alumni, and it's out of Los Angeles, California. FAY, F-A-Y, connects individuals with dietitians and nutritionists who accept insurance, aiming to make professional dietary support more accessible. The company focuses on providing affordable nutritional services and sharing insights on lifestyle changes related to nutrition through their AI-powered platform. So they are health related. Hebbia, H-E-B-B-I-A, AI-powered platform for enterprises, particularly in finance and legal sectors, that aims to enable knowledge workers to effectively search, analyze, and automate complex tasks across vast amounts of unstructured data using AI agents. HeyGen HeyGen is an AI I'm sensing a theme here. AI generation platform that allows users to create videos from text using AI avatars and voices, aiming to simplify video production and make it accessible without traditional filming equipment. Hippocratic AI. Hippocratic AI builds generative AI technology specifically for healthcare. That makes sense, Hippocratic Oath, aiming to enhance patient care and operational efficiency by creating helpful and safe AI assistance for various healthcare tasks. Krea, K-R-E-A, offers a browser-based platform that integrates various generative AI models, which they claim facilitates the creation, editing, and customization of images and videos. The platform provides tools such as real-time image generation, video restyling, and 3D project creation, enabling users to produce and refine video content or visual content. And Mercor leverages artificial intelligence to match job seekers with potential employers by analyzing skills and experiences with the goal of reducing the time spent job searching. And then Nexthop AI offers an AI-driven platform that aims to provide intelligent automation and actionable insights for cloud infrastructure, and that helps businesses significantly optimize their cloud spending and improve the performance and reliability of cloud environments. Upwind is a cloud security platform, aims to provide a comprehensive view of the cloud risk by integrating and build time and runtime context. So they're not AI generated. Wow, let's see, out of the 7, I think 5 of them, 2, 3, 4, 5, 6, 6 out of 8. There was 8 companies listed, even though it's okay. So 6 out of 8 companies listed have something to do with AI. Very interesting. So those are some examples of some up and coming companies that are currently privately held. So the initial public offering is the company's first sale of stock to the public. As an example, Google raised $1.67 billion with 19 million shares in their IPO way back in 2004. According to the textbook, Cargill is the largest privately held company as of the printing of the textbooks, with 106 billion in revenues, employing over 151,000 people. They list Levi Strauss and Company, Hallmark Cards, Hyatt Hotels Corporation, and Petco as other Dole Foods as other companies you might know that are privately held. So what types of stocks are there out there? Well, they're called preferred stock or preferred shares. You're going to get a dividend if you purchase preferred stock or preferred shares. They're more expensive, but they get paid before anybody else gets paid. They have priority over common shares for payment of dividends. They have the growth potential, but they don't carry voting rights. You have preferred stock and you're going to get paid, but you don't have a say on which the company is run. Common stock or common shares, they are paid dividends as declared by the board of directors. They do have growth potential. You do get voting rights with owning common stock, but you are the last to receive any money if in the case of bankruptcy. So you're trading for preferred stocks, you're trading the confidence that you're going to get your money for the power of voting rights that you get with common stock. But with common stock, if the company goes bankrupt, you may not get any money. Some stock exchanges that people would recognize. The New York Stock Exchange started in 1792, where a group of brokers met under a tree in Manhattan and signed an agreement to start trading securities on Wall Street in New York. And they also have a New York Stock Exchange Euronext. That's a collaboration with Deutsche Börse, which is German, and they tried to put it together at first in 2011, but the merger was blocked. And then in 2007, the New York Stock Exchange did successfully merge with Euronext to bring together major market places across Europe and the United States. It's known as the Big Board, the New York Stock Exchange. The NASDAQ originally stood for the National Association of Securities Dealers Automated Quotations, and this is the largest electronic screen-based equity security trading market in the United States. It began in 1971, and it was the first electronic stock market. I usually equate NASDAQ, and it's not always this case, but NASDAQ a lot of times deals with startups and smaller companies and tech-based. So the Amex, also known as the Curb, was purchased by NASDAQ in 1998, but they still continue to operate separately. Over-the-counter trading unlisted stocks that are traded by broker dealers and are not listed on any formal exchange. The foreign stock exchanges, the Nikkei is the Japanese market, and you might, if you watch the news, you will see, the Nikkei closed down today or whatever, and the FTSE, Financial Times Stock Exchange, out of the United Kingdom, they call it the FTSE, and so you might hear somebody say the FTSE, closed up this evening, that kind of stuff. So those are some common stock exchanges and stock exchange abbreviations that you'll see. So to evaluate stock, the stock market is always forward-looking. They're trying to predict future sales and earnings. They look at things like a bull market is a period in which stock prices are consistently rising, like a bull rushing forward, okay? A bear market is a period in which stock prices on multiple broad market indexes have decreased 20% or more over at least a 2-month period, because bears hibernate, okay? So a bear market is when it's pulling back and slowing down. A bull market is when it's moving forward. A correction occurs when some kind of market change has caused a decrease in stock values and sales by at least 10%. So a correction is you're losing a little bit of money, at least 10%, and then it'll start to grow again or not. So it's a, like I told you, it's gambling, and I'm not saying not do it. I'm just saying know what you're doing. You can make a lot of money in the stock market, but people have also put money in there in poor investments, not doing their homework, and they've lost their money. Market indexes provide an overall summary of a specific market or a sector of a market. So it gives you some information about it, and what you use them for is you look for trends. Are things trending up or trending downward? They're also used to benchmark comparison of the performance of other stocks or mutual funds, like the Standard & Poor's 500 is one of the market index. They'll look at the 500 companies, and they'll tell you what's going up and what's going down. The Dow Jones Industrial Average is also another market index, and the NASDAQ, you hear those in the news almost every day. The Dow Jones Industrial Index average, whatever, and the NASDAQ closed down today, amidst wild trading or something like that. You'll hear it on the news. And then there's a stock price trend from 2001 to 2009, noting the big dip around the 2008 because there was a recession. And then some trends that from 2014 to 2015 that showed a little bit of an upward trend. Let's take a quick look. S&P 500. S&P 500 index. S&P 500 today. Market Watch. Okay. Oh, pop up. I have to get rid of that. It closed yesterday. The S&P 500 index closed yesterday at 5,844.19. It is up at the moment 5,886.55, up 42.36 or 0.072% since the closing yesterday. That's as of 10 a.m. this morning. And you can see it's the little screen. It does a chart that changes along as the day goes by. So we are trending up for today. It closed a little bit down yesterday, but it's bounced back up. There was a drop yesterday because yesterday it started at 5,900 at 9:30 in the morning, peaked at 5,903 at 9:37, and then dropped to 58.85 by 9:49. Oh, I'm sorry, that's this morning. It started this morning at 9:30. Sorry, at 59:01, peaked at 9:36 at 59:05, hit a trough at 5.85 at 9:49, and it's struggling back up at 10:06 a.m. current time, 58.91.31. So it is moving along. The 52 weeks range over the last year, it's a low of 4835.04 up to 6147.43 in value. So it's been a 1,500 swing in value in the last year. Top performers: First Solar Incorporated, Supermicro Incorporated, Computer Incorporated, Palantir Technologies Incorporated, Vistra Corporation, Phillips 66 Gas, AES Corp, NVIDIA, Fox Corp, Arista Networks, and Western Digital Corp. Bottom performers: United Health Group, Elements Health, Humana, CVS, Centene, Simon Property Group, Molina Healthcare, Enphase Energy, Merck and Company, and Cigna Group. Well, there's a lot of healthcare in the lower end. Anyway, you can look that up at any time. Just S&P 500, and follow what's going on with the stocks and the indexes. And you can look it up under any one that you wish. And there's a market index sample of futures. Dow Jones Industrials, the markets at a glance, and what's the money doing, and futures, crude oil, gold, silver, that kind of stuff. The Dow Jones Industrial Average is 30 stocks that Dow Jones has decided are representative of the overall market. It's been reported since 1890. The Standard & Poor's, which I looked at, is the 500 large and mid-sized cap companies, representative of the stock market, created in 1957, used by most professionals as a benchmark to judge overall U.S. market performance. It's a fairly good index. And in the PowerPoint, they have an example of how Disney stocks were doing in comparison to the average. Walt Disney Company was up at the time of this data collection. And there's another just stock quotes. It's just showing you what to look for: the high and low prices of the day, the number of shares traded. So like on the example, we're still looking at Walt Disney. The high and low prices of the day for Walt Disney on that date were 106.41 was the low, 107.10 was the high. They traded 3,251,487 shares. That's the volume. 52-week range is the low and the high for the year in the last 52 weeks. The stock market value calculated by multiplying the shares by the outstanding stock market price, which was at that time 181.77 billion. The price to earnings ratio is how many times the stock price divided by the earnings per share over the last 4 quarters. And measure of income from the stock calculated by dividing the dividends paid over the last 4 quarters. So you want those things to be positive numbers, obviously. And so you can look at all of that information on a stock quote. And the next couple of slides after that continue to talk about, what happens with dividends. Corporate profits. Dividends are corporate profits that are distributed to stockholders, and they are approved by the company's board of directors. The board of directors have to approve a dividend in order for a payout. The dividend yield is the annual return received from dividends if you purchase the stock and the dividend payments remain unchanged, because the dividend can change based on the performance of the stock over the year. Startup companies generally will not pay a dividend because what they're doing with their money is they're investing all their cash back into the business to grow it, with the idea that's the thing. When you invest in a startup, understand you're probably not going to make any money for a while, because they're reinvesting all their cash into growing the business, and then once they get comfortable, they'll declare a dividend. And the price to earnings, or the PE ratio, is the market value per share divided by the earnings per share. And that's, how it's an indication of the value of the stock. So they have a slide there about the company evaluation. They do annual reports for the company on different ratios. The current ratio, which is current assets divided by current liabilities, the debt ratios, and the times interest earned ratios. And online, you can just research news on the company. What is being said about them? Are there reviews? Are they getting good press? What kind of reputation do they enjoy? Read predictions from different analysts, and look at their ratios and compare those with other companies in similar industries. But please don't buy stocks based on emotion. Remember how we told you when we were talking about buying a car, don't fall in love with the car and let the car dealership know that you're in love with it, because then you give up your power. If you buy stocks based on emotion, you're taking the logic out of it, and you may not do the right calculations, and you may lose your money. Okay, there's some more stock quote information about Disney. Stockbrokers are full service brokers, are the type of broker where they will provide you the most personal advice. They're probably going to have the highest fees because you get what you pay for, right? You should know your investment objectives and share with them your investment objectives so they know what they're doing for you personally. What is your level of risk tolerance? Are you really risk averse and you want safe investments, or are you out there on the edge? What are your current assets, incomes, etc.? Because they're working for you, and you don't want them to accidentally bankrupt you. They may offer also other services such as financial planning and tax planning, and they will execute the trades for you. A discount broker provides no advice. You have to do that on your own. This is like E-Trade, where you basically do it on your own. They may provide some research tools on their website. They don't build a personal relationship with you. They charge per trade, and they usually have lower fees. You're not paying as much, but you're paying per transaction, and you have to do more of the work yourself. So it's just, where are you comfortable? So some types of trades that you might normally see. A market order is to buy or sell stocks at a current market price. I want to buy this stock. Buy it for me at whatever it is when the order goes in. This is the stock I want to buy. A limit order lets you set a maximum or minimum price before your stock gets converted to a market order. Sell if it hits $100 a share. Don't sell unless it's at least $100 a share. Buy it if it drops down to $60 a share. So it's like putting parameters on what they're supposed to do. An all or none order trade is executed if the entire order can be done in a single transaction. For example, buy 500 shares of Disney, but if there's not 500 shares available, don't buy none. Okay. Stop and stop limit order, buy or sell once the price reaches the stop price. Like I said, it's kind of like the limit order. You set a price and you go, this is my price. Buy it at this price or sell it at this price, depending upon what you want to do. A short sale order, now this gets kind of dicey. A short sale order is when you sell stock that you don't currently own, believing that the prices on that stock is going to drop and you can buy the stock at a lower price than you sold it. Remember how I said that you settle up at the end of the day? So if I have a feeling that a stock is going to take a tumble, I could put in an order at 10 a.m. Well, it's 10:18 right now. At 10:18, I could put in an order to sell 200 shares of XYZ stock. I might not own 200 shares of XYZ stock, but I'm thinking that at the end of, by later on in the day, at like 4 o'clock, it's going to be lower price, and at 4 o'clock, I'll put in an order, buy 200 shares of XYZ stock, and then at the end of the day, those two trades will offset, because I will have purchased the XYZ stock at, let's say, $2 a share and sold it at $10 a share, okay, and made an $8 per share profit. It's dangerous. You got to know what you're doing in order to make money on a short sale order. You've got to have some kind of a really big hunch, because you can't do insider trading. You go to jail for that. But you gotta have a feeling that something's about to happen with a stock where the price is going to drop, so you do a short sale order. A buy to close order closes the transaction of the short sale order. This is when you buy the order. Here's the thing: at the end of the day, you've got to buy the stocks because you've sold them. So if you sold 200 shares of XYZ stock to somebody, at the end of the day, you've got to give them 200 shares for whatever price that they bought it for at 10 a.m. Okay? That means that if you have to buy it at 4 p.m. at a higher price, you've lost money, but you've got to deliver the stocks. If at 4 p.m. the stock is lower and you buy it and you make a profit, good job. Okay? But that's buy to close order. That closes that transaction of the short sale. A day order expires at the end of the trading day if it is not filled. In other words, it's I put in a day order, buy 500 shares of Disney, all or nothing, all or none order. So if you can't get me 500 shares of Disney's by end of closing today, I don't want to buy anything. A good until canceled order gives you typically up to 60 days for the stock trader to make the sale. An extended hours order allows you to place orders through electronic trading networks after the market is closed. That's a 24-hour thing now with internet trading and stuff. A trailing stop order will sell your stock only if it falls a specific amount from the highest price. Now this is, you're playing the averages. So you go, okay, I want to sell my stock if it falls 20% from whatever the highest price is. And a bracketed order is a trailing stop order with an upper limit trigger price that places a sell order. Sell my stock if it raises instead of falls. A trailing stop is if it falls. A bracketed order is if it appreciates in value. So sell my stock if it rises above 20% above this whatever price. And so, that's getting dicey in there. That's not simple trades. So they have a list there of mechanics of trading stocks, and it explains each thing that we've kind of discussed here. And then they have these things called investment clubs. Kind of cool. Members contribute a set amount of money for the club to invest, kind of like going in together to buy lottery tickets. Allows you to research stocks and make recommendations to buy or sell. I don't know that we have one here at Methodist, but some colleges or universities have one. You might want to start one. I don't know if that's a thing or not. They may manage a real portfolio, or it may be an imaginary portfolio, like just a gamification of a portfolio. If you're just watching and getting familiar with how to trade stocks, it doesn't cost you anything really. If you're actually putting money into the stock market, you're probably going to have to do a buy-in. either way, it is a great way to become more familiar with trading stocks. I don't know that they do it here in the economics courses, but when I took economics, my economics professor, one of our assignments was we were given an imaginary amount of money at the beginning of the semester, and we had to keep a log of how we invested our money and what trades that we had, and we had to provide, like if I made a trade on a certain day, we had to provide proof of the price and everything like that. You couldn't just make stuff up. And it was a semester-long event, and your grade, you were graded on how much money did you make or lost. And I remember a good friend of mine, she worked in the paper industry, and she invested all of her money into one company because she knew that company was coming up for sale and it was going to go big. It wasn't a secret, so it wasn't insider trading, but she invested all of her money in that. When the thing sold, it sold up. She sold all of her stocks about 2 weeks into the experiment, invested it into a savings account and CDs, paying a certain amount of interest, and won, just because she had such a big lump sum that she just invested in a safe investment that wasn't going to lose money. And she ended up making more money than everybody else. So it's easy to do, but that's a pretty neat little assignment. Buying stocks directly, you can buy directly from the company. Usually there is a minimum initial purchase, and that can be a big or a small amount depending upon the company. It can be set for monthly automatic purchases from a checking or savings account, and you just would deal with the company directly. Look at its websites under investor relations to see if there's some sort of a direct stock purchase plan. A lot of times stock options are done through your company where you work. So like you have the option to buy stock through your paycheck and that kind of stuff if you work there. And there's no stockbrokers involved in those either. A dividend reimbursement plan, or a DRIP, is a purchase stock directly from the company. The dividends are then reinvested to purchase more shares. You don't get a payout of your dividends, but any dividend that you get, you just end up buying more shares of stock. Allows fractional share ownership. So if you don't have enough money to buy a whole share, let's say a share is very expensive and you don't have enough money to buy a whole share, you can buy a portion of a share. And most direct stock purchase plans are what they call DRIPs, because then you just get more stock until you decide to cash out. You don't get actual dividend checks. It does allow for single share buying in certain areas, but just buy one share of stock in a company and just see where it goes. Independent stage of life. Stocks make great gifts from relatives when you're young. In fact, a very good friend of my mother's, when she was very young, this was a long time ago, someone in her family gave her stock in R.J. Reynolds, which at that time was cigarettes. But R.J.R. Reynolds has morphed over the years, and she just let it ride. She got a certain number of stocks, and they would grow, and then they'd split. And what a stock split means is the stock says, you know what, we're splitting. You now have, where you had 100 shares of stock, now you have 200 shares of stock, but each share is worth half of what it was, so your money's still the same. But then all of those stocks start to grow, and it may split again. And if you let it ride, well, she ended up with a huge amount of what is now RJR Nabisco stock, which was valued, she didn't cash it in until she retired, and that was a lot of money. So, just let it ride. Early family, you can start a DRIP to diversify your investments. I would recommend money markets at any stage. Empty nest, go ahead and diversify your portfolio with some stock purchases that are wise, but I would have a firm financial foundation before buying individual stocks. I wouldn't play with that unless you just really wanted to. And in retirement, review and rebalance your portfolio to maybe be a little bit more conservative. because you don't want to risk money and then have no money to live off of if you're retired. Okay? So, summary, get to work looking over that in the PowerPoint, and the think it through exercises, just some questions to ask about yourself, and that is chapters 12 and 13. Please remember the weekly regular activities plus test number 3 this week, and I will see you again soon. Thank you. Goodbye.